Hey, I'm here with Jen Pacheco with Penrith Home Loans. And Jen, how did you get into lending and what do you love about the business?
Okay. Well, I started in lending because I came from a background as a flight attendant,
That's
and
right.
yep, and so I needed to keep my feet on the ground and just wanted to stay home with my family, and so was introduced to lending from some good friends, and it just seemed like a good fit. Enjoyed helping people, which is I think one of the biggest things about lending is seeing the excitement in people's faces when they start talking about something that they didn't realize they could do, like buying a home and such a big purchase, and then just the fulfillment that you get when you finally do see the keys in their hands and that they've succeeded in making that purchase and creating a space to build their wealth and to raise their family, their
That's
kids.
awesome. I am looking to purchase a home, and what is the process of getting pre-approved?
Okay, so so typically, a lot of clients come to me from realtors historically or from my database. So depending on, usually if they're coming from a realtor, it's a first-time home buyer, and so they're not as aware of the process. And so I always advise my realtors to sit down with them and talk to them about the lending piece and recommend them talking to a lender first so that they are prepared for the next steps to make it successful and as low stress as possible. And so because sometimes people are more ready than they think they are. A lot of times clients think that it's just not possible for them and they're actually ready to roll like the next week. And sometimes clients think that they're ready and they don't realize that they haven't sourced their money, they are self-employed and they need to file their tax returns, things like that. So I'd say that it is very important for a client to meet with a lender first to go over the critical things that they need. So to prepare a client for buying their first home, we want to make sure that they have their credit in order. That we want to make sure that they've thought about how they're going to come up with their down payment and their closing costs, and then so the next step from there, we want to have them actually start an application. So take an application with the lender so that we can look deep into their income, their assets, and their credit.
So what's like the biggest hiccup that buyers run into in the pre-approval process?
Well,
Is there like a
some
reoccurring
right.
thing that
Some typical things that happen is a lot of times buyers come, first-time home buyers especially, come with money that they haven't put into the bank. And they've sold something on eBay, something or several things on Facebook or whatever, and they just have that cash on hand. And that can become difficult for us to source where it came from when you're ready to make a down
Oh,
payment
right.
or put it towards your closing costs. And so that can be a fun one. When they're selling something big, we definitely want to have them put it in the bank right away so that we can source it. Some other issues might be some collections or something on their credit that they may not be aware of, which is another good reason for them to come to a lender first, have their credit pulled so that they're aware of everything that's on their credit and how they might be able to pay something off or pay something down, or their lender can also tell them don't touch anything, just let's just leave it the way it is, because there are a lot of things to consider with collections and balances that might impact in a good or a bad way whether or not they pay it off.
That's interesting about like the liquid cash. So like why is knowing where the source came from so important?
Well, believe it or not, when you're looking at the government and Fannie Mae and Freddie Mac, they want to make sure that a client isn't using money from a source that's disreputable. So money laundering or a straw buyer, so where it's coming from somebody that's just asking somebody to make that purchase on their behalf.
Oh, right. Which would be mortgage fraud, right?
That's right.
Okay. And that's like fairly, like, that's kind of a big thing, I guess, right?
Yeah, it is, but it does happen.
Yeah.
And so in order for our goal is to make sure that the loan that we are securing for our clients is something that that the investor that we sell it to can sell on the fair market, on the market to anybody. So we want to
Right.
make sure that it's a clean loan. And so everything that we do is with that purpose. So we're not just trying to make it difficult for our clients and for
Right.
our realtors, but we want to make it as clean as possible.
Is there a certain set of time that money should be in your account in order not to raise
Yes.
red
Yes.
flags and
Good
things?
question. So typically we ask our buyers to provide 2 months bank statements.
Uh-huh.
So if that money has been in that account for 2 months, then we have no reason to question where it came from.
Gotcha.
There are times that it might be more time than that, but again, a great reason to have a conversation with your lender beforehand so that everything's where it needs to be.
So, like, what are some of, like, the biggest mistakes that you've seen buyers make?
Well, I have seen a buyer drive up in a new car a few days before we're closing,
Right.
and totally unaware, and
That it would change your credit.
that we actually might take a look at their credit and make sure that there are no new liabilities that they've opened since we took the initial application. So in that case, luckily we were able to hold all of the additional debt, but it was we had to do some creative
Yeah.
steps. Yeah. So, but yeah. So opening up new credit once you've initiated the application, thinking that anything you do between then and now isn't going to impact the final closing, and it will. And think about it. Clients are buying a new home, so they want to buy new furniture. They want to buy varying things for that in preparation for that new home purchase.
Right.
So it's important for you to remind them that any big purchases that they make, they should probably talk to you about it first.
You wait until closing, right?
Yes,
Yeah.
for sure, preferably, but at
Yeah.
least mention it. Whether or not it's an issue can be determined
Okay.
if you keep the communication open.
Right. Interest rates are higher this year than previous years. So if a buyer is looking to buy down that rate, what does that look like?
Right. So we're starting out higher in 2023, but there are options for those clients to create a monthly payment that will be more affordable for them, and that's rate buy downs is one of those things. So there are temporary buy downs and there are permanent buy downs, and basically, with the temporary buy down, we're asking the seller to take care of and pay for the interest for 1 or 2 or 3 years to keep the monthly payment for that buyer artificially low for a specific amount of time, 1, 2, or 3 years, and then in that that final year and following would be their final interest rate and what they would pay. And temporary buy downs are good for people who believe that we're going to be in a better rate environment in the next few years. So that that's one way. Now the permanent buy downs, I think, are a lot more conservative because you're buying down the rate. You're using a seller concession or you're using your own cash reserves to buy down, so pay for the rate to be lower, but it's permanently lower. And so what your monthly payment is going to be, as long as you have that loan. So for the term of that loan,
Right.
15, 30 years.
So what would a buyer expect to pay to buy, the rate down by half a point or a full point?
Right. So the amount that you buy down changes with with the market. But I'd say that it's safe to say that 2.5% to 3% cost to buy the rate down by a full point permanently is what it would take
And that is like 2.5% of the home loan,
of
not
the
the
loan
purchase
amount.
price.
Correct.
Yeah, okay. So when you're buying a rate down, is there a limit to how much you
Good
can
question.
buy that rate down?
That's a great question. So there are limits to how much the seller can contribute, okay, to a buy down or to all total closing costs.
Like a seller concession,
The seller
right?
concession, right? So on conventional financing, it depends on how much the buyer is bringing down. So if they're bringing down 5% or less, it is going. I'm sorry, 10% or less. It's going to be 3% max.
Okay.
And then it goes up to 6%, and then if you're bringing 25% or more, it goes up to 9%.
Okay.
That the seller can concede in closing costs.
What if just the buyer is buying it down themselves and not a seller concession?
Well, technically there is no limit.
Oh, okay.
However, there are certain red flags that may be raised in whether or not it's a it's predatorial for a lender to allow a client to bring that much to the table to buy down a rate. And so, theoretically you can buy down the rate as much as you want, but there comes a point where the numbers, the APR would be so high that it wouldn't be allowed.
Oh, okay. Like it wouldn't quite pencil out.
Right.
Okay. Oh, interesting.
Yeah.